rents. Why did you kind of hone in on that market?
Yeah. Well, and so what we were originally looking for, which is very difficult to find in today's national market, right? There are very few regions of the country where this is true now. But at the time, we were looking for where was the rent and homeownership relationship upside down, meaning that it was cheaper to buy a house than it was to rent the same house.
Interesting. Okay.
And now, rates were low, certainly not as low as they went during the early 20s, right? But so the ratios were very compelling, and
sorry to jump in, but why did you want that ratio? Usually, you want it to be cheaper or to be cheaper to rent than buy, because that kind of gets people to rent houses, and so you have a lot of demand in what you're buying. But you wanted the opposite.
Yeah. But I mean, if you think of it from a return on equity point of view, right?
Okay.
This was a period of time where you could, an investor could buy the 1% property, if you will, meaning that 1% of the purchase price and monthly rent. But you could buy the asset and immediately rent it out at a profit, right? Given where rates were at the time and some normal assumptions about vacancies and maintenance and that sort of thing.
Nice.
And we also thought that, we bought quite a lot around the General Motors area. And we really, there's some beautiful towns around there. And we really thought that the auto industry was not going to go out of business, right? And that was a very difficult time for Michigan during that period. But we, it's kind of like you try and buy when, as a general investing principle, like you try and buy when everybody else is leaving.
Yeah. You zig when everybody's zagging. That is a good strategy to have.